Hey, good afternoon, everyone, and welcome. Thank you for all for dialing in. We don't think you'll be too disappointed by what you hear and what we hope you learn today. My name is Ted Howard, and I'm the managing editor of iTreasurer, a leading provider of information for corporate treasurers. I also help run a few treasury peer groups for NeuGroup. For more than 20 years, NeuGroup has been a trusted thought leader for global finance and treasury professionals. We run a network of member-only peer groups covering senior level executives, functional and regional treasury, as well as finance. We now run 18 groups cutting across sectors like finance, functions, and global regions, with more than 450 members from 200 plus companies. Today we're joined by Susan Gammage, Head of Transaction Sales Americas for Thomson Reuters, who's going to explain the ins and outs of FX algos and how you should be utilizing them in your portfolio. Susan's been in her current role since 2011 and has more than 25 years of experience in the FX markets, having joined Thomson Reuters from Citibank, where she was global head of e-commerce. But before we get started today, I'd like to get a few housekeeping items out of the way. First, I encourage you to submit any questions you have through the question box on your toolbar. Depending on the volume and nature of the questions, we'll try to answer them today, but due to the number of participants on the call, we may not get to them all. So if you don't hear an answer to your question, Susan or someone from her team will follow up with you directly. Also, an email will be sent out to all registrants containing the link to view a print-friendly version of today's slides, as well as a recording. So let's begin. Algo trading in FX has grown tremendously in recent years, and not only in the very large trade space, but also in the under $20 million range. So what explains this? Well, for one, algos can help corporates navigate an increasingly fragmented trading landscape. They also offer great execution and best price, both of which FX managers like to hear and see. So on today's webinar, Susan will drill into these and other advantages of using algos, as well as how best to incorporate them into your FX management program. So without further delay, here's Susan.
Ted, thank you so much, and thank you very much to all the folks that are on the call today. Let's talk about the agenda. The first thing that we're going to go through is an introduction to FX algos. We're going to talk specifically about the growing adoption of FX algos, the main types of FX algos being used in the market today, 5 key reasons to use FX algos right now, and then we're going to go through an overview of an algo execution on the transactions platform, FXAll. And then we will happily take your questions. Okay, so in the context of today's webinar, by algos, we mean automatic electronic execution strategies. Algos are a set of instructions given by a trader to a computer program for the purposes of executing a trade. In other words, they are automated and they're rules-based, meaning that a trader can typically start by configuring an algo. They select certain execution parameters that will instruct the algo on how to achieve its objective, and then the algo takes those instructions and executes a trade in an automated way without any further human intervention. Typically, algos break up the initial parent order, so the large order, into what we call smaller child orders that are then filled over time to achieve one or more predetermined objectives. Regarding the origins of algos, I'm sure you might be aware that algorithmic trading has already left its mark on the equities and the derivatives markets, where algos drive a very high proportion of flows. What we have witnessed in the last recent years is strong growth in algo trading in other highly electronic and liquid markets, including some OTC markets, and in particular, specifically for today's call, FX. As the FX market has in large part shifted to electronic execution, the most liquid and highly electronic portions of the FX market are becoming increasingly suitable for algo execution, in particular, spot FX. And as you can see here in the graph to the right, according to the iTreasurer, algo trading accounts for 25% of spot FX volume. More recently, there are several market factors that have driven accelerated algo adoption in FX. Specifically, the wave of regulation that followed the financial crisis has reduced banks' appetite, their ability and willingness to warehouse risk on their balance sheets, as well as their proprietary trading activities. As a result, they are acting much more frequently as riskless principal, increasingly using automation to match client orders and providing agency services in exchange for a brokerage commission, rather than holding inventory on their balance sheet and bearing the trade execution risk. In parallel, there is growing pressure, I'm sure you feel this yourselves, from regulators and asset owners on the buy side, pressuring the buy side to achieve and demonstrate best execution, in particular under MiFID II, which we all are very aware of. As traditional dealers no longer concentrate on much liquidity, as non-bank market makers have stepped in and have started to make prices, and as new electronic trading platforms emerged, liquidity in FX has become increasingly fragmented across venues and counterparties. And lastly, consumers of liquidity on the buy side are becoming far more sophisticated users of advanced trade execution and analytics tools to enhance their execution and to navigate the increasingly complex trading landscape. So all of these factors contribute to the growing use of algos in the FX market. Algos provide a consolidated view of the market, enabling market participants to source liquidity across multiple sources and multiple venues. And they also provide a way to ensure efficient execution of large orders at the best price with minimized market impact, which we'll talk a little bit about in further slides. And here at FXAll, as reflected in the bottom graph, we have witnessed the rise in the use of FX algos. Just last year, our algo trading volumes on the platform doubled, and with this strong growth trend that we see in 2018, a 325% increase has been seen in algo volumes traded on FXAll. So the growing adoption of FX algos by corporates. Clearly, algos are becoming an increasingly crucial key tool for FX traders. And at FXAll, we can see that being the case across all buy-side market participants, not just with large hedge funds and asset managers, but also increasingly with corporate traders. According to a 2017 report by the Greenwich Associates, approximately 10% of all corporates are using FX algos. And no surprise, in particular, algo usage is especially high among the biggest and most active corporate FX clients, those who are trading over 500 yards a year, with a quarter of them using algos. And I think that's really an important point because that is what we continue to see on our platform. Algo usage by corporates on FXAll has grown steadily, though not as fast as with the asset managers, but corporates are certainly becoming increasingly aware of the potential benefits of algos and are becoming more comfortable using them, as you can see from the three graphs. So let's talk about the main types of FX algos. Algo selection can be intimidating for some folks, given the sheer number of products that are now available from banks. If you are just getting started with algos, we at FXAll suggest using a simple framework in order to evaluate the algos, understand what results are likely to be achieved, and most importantly, assess whether or not they are suitable for your trading objectives. You can assess a given algo along three main dimensions, as you see on the slide: the algo's stated objective, its execution style, and its liquidity sources. So let's talk about those a little bit more. Regarding the algo's objective, we can differentiate benchmark algos from opportunistic algos. A benchmark algo is, as the name suggests, typically trying to achieve a specific benchmark price or fixing. That would be the case, for example, with a TWAP, a time-weighted average price algo, or a VWAP, a volume-weighted average price algo. These algos will try and achieve the average price over a given time period, for example, during a benchmark fixing window. An opportunistic algo, on the other hand, is simply seeking to access liquidity, of course, opportunistically. The next main dimension is execution style. When evaluating algos, you may want to consider whether an algo works passively over a certain amount of time, seeking to capture spreads while maintaining a desired execution rate, or whether it works more aggressively, seeking to capture as much liquidity as possible immediately and potentially causing it to cross the bid-ask spread. To use the same example again, TWAP algos are typically algos that execute passively. They will break the parent order or the large order into smaller, what we call child orders, and spread the execution of these child orders evenly over a specified period of time. And lastly, liquidity sources. You may also want to consider whether an algo is accessing the provider's internal liquidity pools, whether it's accessing liquidity pools that may be external to the provider, such as ECNs, for example, or maybe it can or is accessing both. This dimension is important because where and how algos source liquidity can have a material impact on the ability to reduce information leakage and minimize market footprint. Using this simple framework, it's important to spend time understanding which algos to use, how to use them, and when is an appropriate time to use them. Here at FXAll, your relationship manager can easily and happily work with you alongside your liquidity providers to assist you with your algo selection. Once you've spent time evaluating a few of the algos, you can then start to form a view as to which ones fit your trading objectives, your trading styles, and your urgency. You can also determine how you may want to customize the algo's execution parameters. So for example, consider whether you are willing and able to go with the more passive execution style and spread the execution of the trade over a period of time in order to minimize the spread paid. Or, on the other hand, maybe getting the trade done quickly is more of a priority for you, in which case you may want to customize the algo execution style to be more aggressive and have it cross the spread, as we said earlier, more opportunistically. All right, let's get to the 5 reasons. Reason number 1, minimizing spreads paid. One of the key motivators for using algos is their ability to minimize spreads paid. As we've just seen, algos and passive strategies in particular can help generate cost savings by spreading the execution of a trade over a period of time. Especially when there is no immediate need or urgency to complete the trade, which can often be the case for corporate treasurers, algos should be considered as a part of your execution menu. Many of our corporate customers have benefited from using passive algo strategies and over time have observed that the cost of using algos were on average less than the spread that they would have paid for a particular typical risk transfer trade. Reason number 2, minimizing market impact. Another common reason that firms use algos is to minimize market impact, particularly for large orders. Executing large orders continues to be a pain point for many of our market participants, and algos are one of the best and honestly one of the simplest tools traders can use to facilitate the execution of large requirements. Under the right conditions, algos can be very effective at splitting large orders into smaller child orders and sending them to the market over time across various liquidity sources to reduce their market footprint, meaning letting the street know that you are trading in large lots. One of the major benefits for our corporate clients who use FXAll, particularly for algos, is for large trades relating to corporate actions, acquisitions, and other extraordinary life events in the lives of their companies. The more sophisticated algos use randomization very effectively to minimize the risk of other market participants detecting the algo's execution pattern. For example, That could take the form of randomizing when each fill of a TWAP algo is placed into the market rather than following an even pace. For example, placing $1 million trade into the market every 10 minutes. As we previously discussed, where and how algos source liquidity can have a material impact on their ability to reduce information leakage and minimize market footprint. As a result of how algos interact with sources of liquidity, especially during times of volatility or when liquidity is scarce, may actually create significant market impact, and other market participants may very well be able to identify the algo's behavior and then in turn react. So one should carefully consider the algo's liquidity sources, whether it's accessing the bank's internal liquidity only via their internal matching engine, or whether the algo is distributing the child orders externally over multiple trading venues. Reason number 3, another key driver of algo adoption is their ability to access a broad range of liquidity sources. Given the proliferation of trading venues and counterparties that I mentioned earlier, it can be complicated and costly to access and maintain all the necessary venue connectivity. Algos essentially provide this access in a cost-effective way, bringing together all the necessary sources of liquidity. And they tend to do this in a very intelligent way, which is one of the key benefits. Meaning, for example, when liquidity is scarce, or when you have a less liquid currency pair to trade, or perhaps you're trading during a less liquid time of the day, algos can be better equipped to find that liquidity and reduce market impact while the order is executing. We often find this in the emerging market liquidity pairs. Reason number 4, one of the key differentiators of algos relative to other execution methods is their potential to automate certain trading activities and increase operational efficiency. Market participants who adopt algos are able to automate the execution of some of their more routine trades. And that in turn can free up the trading desk and traders to focus on other matters, such as their more challenging or more complex trades. As market participants on the buy side continue to face cost pressures, we continue to see the potential to increase productivity through automation, which will be a key driver of algo adoption. Essentially, what algos allow you to do is free you up to focus on other activities, other more challenging trades that you have to create, or other work that your department is focusing on. And lastly, reason number 5, enhancing operational efficiency. When it comes to demonstrating best execution, algos can help provide far greater transparency into trade execution. Algos lend themselves well to TCA, or transactions cost analysis, since they provide an audit trail of execution prices and timestamps at the fill level. Fill level information provides details on how each child order was executed, at what price, on what venue, etc. And all of this data can be used for post-trade best execution analysis, or alternatively, for risk management purposes. This is something that we hear from our customers all the time, and one of the key reasons, which is why it's reason number 5, enhancing operational efficiency, and in particular, being able to demonstrate best ex and post-trade analysis has been by far the most common theme for folks trying to look at algos. So let's talk for a couple minutes about the FXAll Advantage for corporates using algos. Now that we've covered the basics on how to evaluate algos and discuss the expected benefits of algo trading, I want to highlight how at FXAll we have made it very easy for you to send an algo order to the liquidity provider of your choice. First of all, FXAll supports a wide range of algos provided by the leading liquidity providers that you see on the right-hand side, and that's just a handful of them. You don't need to have 10 different bank portals on your desktop with 10 different passwords to access the algos of 10 different banks. Instead, All that connectivity is done through FXAll. We consolidate access to all of these algos in one place, in one desktop, and you have the benefit from a common workflow, from a common and consistent user interface across all of these providers and algos. So if you are considering trading algos for the first time, we've given you a convenient place, an easy way to start. Algo trading is a part of a broader range of execution management capabilities on FXAll, which also includes an advanced execution blotter with order management features such as cross-currency netting and allocation. And in addition to algos, FXAll users have access to other execution methods, including RFQ or request for quote, access to streaming prices, batch orders, an anonymous order book, as well as the ability to execute resting and fixing orders. Our customers also enjoy a growing suite of analytical and reporting tools that can help you measure the quality of your execution. For many years now, FXAll has helped clients understand whether they are receiving a fair price, quantify the spreads they pay over time, access provider performance, as well as gauge market conditions. Breaking news, we are in the process now of rolling out our improved platform for trade analytics and reporting, which will feature a real-time and interactive user interface and will ultimately tie into the FXAll trading workflow to empower traders to make better informed decisions on a pre-trade basis. So you folks are the first to hear about that today. FXAll users also have access to Settlement Center, our automated post-trade processing platform. And finally, I will point out that FXAll is integrated with all the leading treasury management systems, so you can benefit from automatic straight-through processing of your algo trades from and into any treasury management system. Getting started with algos on FXAll is easy. Rest assured, we will help you. In a few hours or less, you can be set up to trade algos with your FXAll relationship manager assisting you through the entire process. Permissioning for algo trading is easily managed by the FXAll relationship manager. You simply request access to a specific algo provider and their algo strategies, and coordinated by the relationship manager. We map the provider to your account, and you're off to trade. Importantly, unlike some of our competitors, to trade algos on FXAll, there is absolutely no need for any new contractual agreement. And very importantly, there is no additional access fee to start trading algos on our platform. So let's have a look. Once you're ready to start trading algos on FXAll, placing an algo is very simple. So here's an example of what an algo order entry window may look like. And now you'll start to understand some of the things I've talked about more in terms of the timing and the market impact and the slicing and the parent and child orders, et cetera, through this window. So the amount specifies the order size. TWAPs are typically and frequently used to execute larger sliced orders. The venue field is used to select the bank providing the algo. So algo providers on FXAll, meaning the banks, offer each of their own sets of strategies. The strategy field is used to select an algo strategy such as a TWAP or a VWAP. They're in number 3. Number 4, the limit field can be set to ensure execution will not occur at a price worse than the limit price. Super crucial. Number 5, the slice interval. The slice fields can be used to determine the number, the size, and frequency of the individual slices or the pieces of the trade in the TWAP algo order in this example. And number 6 is the duration. So the duration field sets the start and the end time of the TWAP. So while the parameters vary by strategy and provider, what I wanted to demonstrate here is that we really make it easy for you to enter your preferred parameters, and we are now rolling out algo templates that will default to parameters that you've previously saved for use in the future. So these templates will ultimately reduce the number of mouse clicks required to place an algo order to 1 or 2. So what I hope I've done in the last 30 minutes is give you some food for thought. Have you think about why algos, how you can use algos efficiently for your own firm's needs, how easy it is to use algos on the FXAll platform, and how comfortable it is because we essentially make it a partnership between the FXAll relationship management team and the customer and the liquidity provider. So I think I'll pause there and see if there are any questions. I don't
Thanks.
know, Ted, do you see anything there?
I do. I was going to ask you a question, actually.
Okay.
So we've heard you say that algo trading has increased on the FXAll platform. Maybe you can talk a little bit about the factors that are driving that.
Well, one of the things that we've found that's so exciting and interesting really is that, as I mentioned earlier, we've seen our algo usage grow, double essentially since 2017. And, you know, there are a number of early adopters that were integrating algos into their daily trading. And I think, you know, what we've seen specifically with the asset managers and hedge funds is that it's really about workflow and the efficient execution of the orders at the best price. But what we're also finding is that for corporates, it's not only about workflow, but it's also about operational efficiency. That because corporate treasurers typically have not just FX to do, but other asset classes, being able to trade algos on an electronic platform and minimizing spread costs, enhancing their trade execution and the operational efficiency, they basically can move on to other tasks that they have within the Treasury Department. And so I think it's partially a function of the operational efficiency. I think it's also partially a function of the fact that as more corporations are trading electronically, they're becoming more comfortable with putting all of their trades over an e-platform, and this is just sort of the next step for them.
Yes, and you know, we're seeing that from the NeuGroup's perspective as well. In each of our FX, we have FX1 and FX2 groups, and over the last year or so, we've seen a lot of interest. There's one user who's kind of a marquee name, very big company. They went from 0 in, say, 2015 to, or actually 2016, to being a regular user now. They did all the requisite research and they did a bit of a trial before starting it. And I think that's probably going to inspire other members of those groups to do it more. So I think we're going to see a lot more growth. So let's move on to, there's another question on TCA. This question is, let's see, spread capture and market impact are terms mostly relevant to transaction cost analysis. Do I need a robust TCA process to be able to communicate these savings in my firm?
Well, I could answer that question two ways. I guess I would say, you know, it depends on how you define robust, if you will. You know, we hear from customers that the type of TCA that we provide from FXAll for certain customers is certainly very satisfactory. And the fact that we are rolling out this new, more robust TCA, I think is going to be very beneficial to all of our customers, because essentially what it allows the client to do is feel comfortable about the execution price, the timing, the peer group, and be able to, if you will, not just defend why they executed at a specific time, but why the price specifically. What we hear from a lot of customers is that there's varying levels of interest with respect to post-trade TCA, as well as pre-trade TCA, and whether or not customers feel they need, you know, perhaps more robust TCA in the form of real-time analytics. And there are a number of firms, including ourselves, that are adding that specifically into our product in order to be able to demonstrate this for our customers, but also evolve as the customers have asked us for more. So do I think it's required? It really honestly depends on the firm that you're at. Certainly for asset managers and for hedge funds, they seem to be driving a greater requirement for more robust pre-trade analytics and pre-trade TCA. And we're seeing that a little bit less perhaps in the corporate space. But what has been interesting is as the asset managers and hedge funds continue to be really active in driving some of this market evolution, the corporates are just behind them. So, you know, what I would say is that what we're doing in terms of our TCA is probably going to be very beneficial and satisfy the majority of requirements for certainly most corporates on the platform. So we're excited to share that with our customers. And as I mentioned in the previous slide, that we're rolling that out right now. So that's hot off the press.
Good, good. So the next question is kind of a two-part question, and it also has to do with TCA. It's been described as more of an art than a science. Is that something you would agree with? And what do you see as the next step in its evolution with respect to FX trading? And then also, do you find, do you think there's a greater understanding and greater uptake of TCA solutions?
Yeah, Hart and Science. I would definitely say there's no question that it is not only an art, but also a science. And, you know, I think that's really because given the nature of the over-the-counter FX market and the difficulty with forming a representative view of what the overall market looks like for comparison purposes, you know, there are challenges around typically assessing the performance of your FX trade and the costs associated with it, which is why the reporting and the pre and post trade analysis is so important, because you then can create some history to make some sense of the timing, the liquidity providers that you're selecting, the size of your trade, you know, et cetera. So, you know, there are lots of questions around the timing and the timestamps of a particular trade, and, you know, how do you measure that? Meaning, like, you know, are you starting that when the trading desk submits the order, when the order is executed, when the order, you know, there's just so many pieces to it that I do think it's not only an art, but without a doubt, a science. And then I think the second part of your question was about, you know, greater uptick.
Uptake.
I would say,
yeah.
Uptick. Yeah, I would say we see that in the hedge fund and asset manager community in every single demonstration that we participate in. There's a large part of the conversation that is around TCA and EQA, and a number of the capabilities and functionality that we've addressed to be included in our product over the last 2 years really have met the need of those customers asking us to continue to enhance and create more capabilities to address those questions. And, you know, what I hear from customers and prospects, myself personally, and my team here is that this part of the conversation is becoming increasingly more common with our corporate customer base, either existing clients, of which we have many thousands, and we are the largest platform for corporates, voted by Euromoney for, I don't know, 15, 16, 17 years now, but also for our prospects too.
So you think that, I think in one of your slides you had that, you showed that exponential growth. So do you think that's going to continue exponentially, I suppose, because it's
Oh, absolutely.
I mean,
So I only went through March. I mean, we've already seen in April and May, continued growth. Absolutely. Absolutely. And in fact, a lot of our investment is really around continuing to add more algos from our bank providers to the platform in order to address this demand. Absolutely.
Great, great. Okay, well, I think that wraps it up. Susan, thank you so much for giving us the ins and outs here and drilling into some of those parts of FX algos. And thank you all for dialing in or clicking in. Thanks very much.
Absolutely. Thank you. Have a great day.
You too.